Before you buy any rental property, you need to know one essential truth. If the numbers don't work, the deal doesn't work. It doesn't matter how attractive the property looks or how confident your real estate agent is. Real estate is ultimately about the math behind it, and today, we're going to walk through how to analyze a rental property step by step, even if you're starting from scratch. This channel focuses on building wealth through smart real estate decisions, not emotional ones. So, grab a calculator. By the end of this video, you'll have the knowledge to determine if a property is a money maker or a money pit. Let's dive in. Step 1 is to assess the purchase price. For our example, let's say the purchase price of the property is $250,000. This figure serves as your starting point, but we must look beyond this number to understand what it will cost you monthly. Assume you're making a 5% down payment, with a 7% interest rate on a 30-year mortgage, resulting in an estimated monthly mortgage payment between $1,600 and $1,700. This is where your analysis begins, but it doesn't end here. The second step is estimating potential rent, and it's crucial that this estimation is realistic. Let's say the market rent is around $2,000 per month. But remember, don't just guess. Check resources like Zillow rental comparisons, Facebook Marketplace, and local listings. If you find similar homes renting for $1,900 per month, do not assume you can charge $2,300. Always be conservative in your estimates. Now, moving on to step 3, we must calculate all expenses associated with the property. A common mistake for beginners is to only consider the mortgage payment. The truth is, you need to account for several other costs. Here's what you should include. 1. Mortgage, $1,650. 2. Property taxes, estimated at $300 monthly. 3. Insurance, around $150 per month. 4. Maintenance, let's use a general rule of thumb of 5 to 10% of the rent. We'll take 8%, equaling $160. 5. Vacancy, this can be assumed at about 5%, which amounts to $100. 6. Property management, if you choose to hire management, that could average 10% of the rent, so $200. Even if you plan to manage it yourself, include this cost in your calculations to keep your analysis realistic. When we total these monthly expenses, we arrive at $2,560. Here's the breakdown: $1,650 for the mortgage, $300 for property taxes, $150 for insurance, $160 for maintenance, $100 for vacancy, and $200 for management. Together, that's $2,560 per month. Once we have all the numbers, we can calculate cash flow. If the estimated rent is $2,000 and the total expenses are $2,560, you're looking at a negative cash flow of $560 per month. This means the property is not an investment, it's a liability. Let's tweak our scenario a bit to illustrate. What if you put 20% down? Your mortgage would drop, bringing your total expenses down to around $1,900 per month. We still estimate the rent at $2,000. Now, you'd be cash flowing $100 monthly. It's not a huge amount, but this is a starting point that can make the deal worth considering. In step 5, we need to understand the cap rate. The cap rate is calculated by dividing the net operating income by the purchase price. The net operating income comes from rental income minus expenses, excluding mortgage payments. For instance, if the annual net operating income is $18,000, divide that by the $250,000 purchase price. This results in a 7.2% cap rate, indicating a potential return on investment. Typically, beginners look for a cap rate between 5% and 8%, depending on market conditions. The 6th step involves asking yourself some critical questions. Does this property cash flow? Will it appreciate over time? Does it make sense in the current market? Does it align with your risk tolerance? Real estate isn't solely about cash flow. It also includes considerations like loan paydown, appreciation, tax benefits, and long-term leverage. Avoid common beginner mistakes such as overestimating rent, ignoring maintenance costs, forgetting about vacancies, buying based on emotions, or assuming appreciation will save a bad deal. If a deal only works under perfect conditions, it's likely not a good deal. A simple rule for beginners: if the numbers confuse you, simplify them. If your rent minus all realistic expenses results in a positive number, you can continue your analysis. If not, it's time to walk away. Remember, There will always be another opportunity. Real estate rewards those who are disciplined. The successful investors are calculated, not lucky. If you're serious about building wealth through real estate, not hype, subscribe to this channel as we continue our journey together.